right. Well, as folks continue to come in, thank you everyone so much for joining us today. For those who don't know me, I'm Chris Lestrino, founder and CEO of Kingscrowd. For the past nearly 8 years, we have been focused on providing institutional grade research and analytics tools for maneuvering alternative investing. A key emphasis and focus of ours is really focusing on private equity and private debt deals. Um, but what we try and do with our sponsored educational programming is to focus on other alternatives that we're not already covering so that we can help you uncover other investment opportunities beyond traditional private equity and private debt offerings in companies. So today we have a really, really interesting discussion set up with Dr. Stephen Kaufman, the founder and CEO of Zeus. Zeus Companies is a super interesting real estate investment platform with a 20-year track record, with continued payments back to investors, great returns to actually speak of, with $7 billion invested in real estate deals across more than 17,000 deals with less than a 1% loan default rate. For us, everything that we do at Kingscrowd is about providing great education, but also trying to identify great investment opportunities, right? There's no guarantees with anything in life when it comes to investing, but finding great operators on the investing side that can help you identify and invest in really great investment opportunities. That's what we're all about. We want to help you be an informed, thoughtful investor who can access best in class investment grade products across all of the alternative asset classes. So I think there's going to be a really, really interesting discussion. We're going to bring Stephen on here in a second to dive into this topic. But what we're talking about today, right, is kind of the less sexy side of real estate and investing on the debt side, but that has a really, really strong positive return profile. So I think it's going to be a really interesting discussion. And please, as always, our Q&A section is open throughout. Please start dropping your questions as you have them. And then once we hit around the 30-minute mark, we will start taking those questions from all of you and dive in on the topics you want to hear about. So with that, Dr. Stephen Kaufman, thanks so much for joining us today.
Yeah, thanks, Chris. Thanks for having me.
It's my absolute pleasure. So first off, I mean, you have a really incredible track record. You truly do. 20 years. There's very few people in kind of this alternative investing sector, especially with a digitally native presence that have been around for 20 years. So tell us a little bit about your founding, how you came to create Zeus Companies, and what you've been up to for the past 20 years.
Yeah, thanks, and thanks for having me again. The origin of our company is real estate investing, and I started investing in real estate very young in my life and in my career. About 28 years ago, I started investing in real estate, and at the same time, we started a small debt company. We realized pretty quickly after creating this lending company, ZeusLending.com, that there was a very specialized niche inside of real estate lending, which involved landlords, home flippers, builders that had very specialized needs compared to the general borrowing population. So if you're looking to buy a home, you have a particular set of needs if you're going to live in that home. But if you're going to buy a home to fix and flip, these people have special needs. And we understood those needs because we were also in that same business doing the same thing. And for the same reason why you wouldn't go see your primary care physician for a heart issue, you'd go see a heart doctor. We have become known as the go-to source for sophisticated home flippers and builders and landlords to get financing that's tailored and specialized for them. So that's how the company started. And we didn't really pick this niche, it really picked us. And what we have found, we use the analogy of these HGTV home flipping shows that we've all seen that have been around for 20, 25 years plus, where they buy the ugly house and they renovate it, do the big reveal, show you the big check, and then you get to see how much money they made, and gets everyone really excited about real estate. And these shows, what you're not aware of is that, or thinking about, is that who is actually providing the financing for these houses. And what we realized after 20 plus years and $7 billion in transactions, that the money's not made in installing backsplashes, it's made in being the bank on those transactions. And a good parallel to that, if you're familiar with the story of, selling shovels during the gold rush, there's a lot of speculation during the California gold rush, but the folks who were selling shovels to the gold speculators were the ones who really made the money. And in essence, being the bank during the real estate evolution that we've and revolution that we've experienced in our lifetime, and it's still growing and going, thanks to technology and transparency and availability of resources to people like you and me and everyone on this call or webinar. It's the position to be in is the bank's position because that's has the safest equity position in the asset, even though it's not an equity debt position. But when everyone's paid down, who's going to get paid most often is going to be the bank. And so we realized pretty early on being extremely risk adverse. I grew up fairly poor in a very poor location, so risk adversity is really important to me. I'm the only thing I'm not allergic to almost any food. When I'm asked if I'm allergic to anything, the only thing I'm allergic to is losing money. And the way as philosophically the way I philosophically manage that risk is by creating a unique skill at underwriting. So our company, Zeus Companies, is a private equity company. We have our debt platform, we have an equity platform, and a healthcare platform. And across
Hmm.
all those platforms, Chris, the unique skill that we bring is our underwriting and assessing the risk of a transaction. That's what we're uniquely good at. And we've deployed that skill to investors who realized they didn't want to actually be landlords. They didn't want to get calls in the middle of the night to fix a toilet. And we're all sold this illusion of passive income when we're a landlord or passive income when we invest in other transactions. But we have found that there's very rarely a passive real estate investment outside of being a bank or a lender. And even that is not passive if you have defaults and troubled assets or troubled borrowers. You have to then now actively participate in the workouts of those loans. So we figured out that that's a skill that we have very easily managed, and that there are investors who like lending money or being involved in real estate but don't like the risk. And those
Hmm.
we've scaled our business partnering with those investors and offering them a product that they really love. That's the long answer.
I love it. No, and let's, you know, the home flipping loan is a very unique, specific loan class, right? Can you talk a little bit about what unique profiles and things come about in needing those home flipping loans that is distinct from other loan products out there, both from, the actual sourcing and the diligence and all of that and what it looks like, and then what does it mean for an investor as well in terms of return profile?
Yeah, great question. So fun fact about conventional lending, like getting a loan through Fannie Mae, Freddie Mac, FHA, or USDA, is that if you have a property that's missing a major appliance or has a window broken or a door missing, you can't actually get a conventional loan. That loan is not in a suitable condition to get that loan. So you would have to get alternative financing, or you'd have to
Mm,
get seller financing, or you'd have to pay cash. So lenders that are occupy the space that we have been in for over 20 years provide this niche product where we're providing financing that a traditional bank would otherwise not do. We're providing it to a borrower who has a credit profile that's very good. It's not that they themselves don't qualify for a loan. The asset they're acquiring doesn't qualify for the loan. And
mm,
we have filled that gap. And because we're filling a gap that other institutions won't, we're able to charge a premium in term and rate. And so in fees. So when we're able to charge a premium for all of that, we obviously as a company profit from that, and we share that profit with the investors who partner in our loan portfolio. So the type of borrower that we work with is typically a well-qualified borrower, someone who's actually employed, who is looking to fix and flip a house on the side as a side project, maybe to pay for their kids' college education or pay for their retirement. They want to start establishing a portfolio. That's our typical borrower. But our typical investor is someone who's actually tried all of that before and realized it's
hmm.
not quite what they thought it was going to be. And they realized that making $200 a month in cash flow on a rental property was wiped out by one roof repair or one HVAC repair. So they didn't want the responsibility of dealing with that tenant any longer because the return wasn't there for them. So then they align with us where we provide debt to well-qualified borrowers, and then share the note opportunity. So where investors can actually participate in the note that we've made, and they get to make passive income from that note, not by swinging a hammer, but by logging into our portal.
I'm curious, having kind of looked at some home flipping loan products in the past. what is the typical length and nature of these? 6 months, 9 months, 12 months? And then are these structured as kind of like balloon payments where they don't have to pay anything until they sell the home? Or is this every month they're paying back?
Great question. Philosophically, from a risk standpoint, I've studied, we have completed 17,000 loan transactions and over $7
Incredible.
billion in loan volume. And what I will tell you is one thing I know for sure that everyone in your audience should know is that any loan without payments has a higher default rate than any other loan. We never allow a borrower to not make payments at all of any kind because that's how we keep our hand on the pulse of the transaction. If
Mm,
that, so we know very quickly within 30 days or less if this transaction is going to be in trouble or not. And the sooner,
mm,
like all issues in any business investment, the sooner you can rectify the troubled situation or correct the troubled situation, the sooner you can more likely align to what your proven exit's going to be. So first, just to address the last thing you said, there's no balloon payments. There's usually, these are terms of 6 to 12 months. The average loan stays on our books about 8 months, give or take, on average. And when that investor, the borrower, fixes that home, gets it stabilized so that it now looks like a pretty house in the neighborhood, just like the HUD TV shows, and puts it on the market to sell. Once the house sells, almost inevitably they come back for another loan, trying to do it
mm,
again and again. And because we have many borrowers who don't need the product, they have plenty of cash. They use a lender like us as a security blanket, as a second set of eyes, because we're going to fully underwrite this. And because we are in the commercial real estate investing business, Chris, we don't just make loans. We have something called a multi-layered underwriting structure where we first underwrite the investment like it's our investment.
mm.
Would would we and could we make money on this? Okay, maybe we could if we had to. But we also then underwrite it as a lender. And what is our likelihood or our propensity to make sure that we're going to get paid? And we have over 17,000 transactions, skewed that and narrowed that down to a very finely tuned science of knowing with a high level of predictability that we will be paid as agreed. Um, Great questions.
So, in terms of diversification, when folks are investing in your portfolio products, how many investments are typically in each one? And then I believe you do monthly or quarterly kind of payments out. So, if you could get in kind of the details around payment structure.
Yeah, these are great questions. I mean, to kind of wrap this up a little bit in a more overarching shell, I want to tell you that it's a pretty boring investment. So I want to get that out of the way right now. This is not very sexy.
Boring is good.
Depends who you ask. Some people
It's
get
true.
really excited and they really are really motivated by the speculation or opportunity to make more money in larger, more risk-prone investments. This is fairly boring. We pay monthly distributions. We've been paying monthly distributions uninterrupted for over 20 years. This is
Wow.
during the dot-com, during the subprime crisis, and during COVID. And we have always found, just like we find with our borrowers, we can tell there's an issue with a borrower if they don't make our payment. We want our investors to have the same sense of security with us so that they can feel comfortable that every 30 days they're going to get a distribution from us against their collateral and their investment. And you mentioned the question about how many properties. It depends on the dollar amount that you invest. In we're about to open our passive income fund for new investment on August 4th. We haven't had it open in a while.
Oh,
It's
cool.
about to open again on August 4th. And when you invest in that, depending on the dollar amount, is how many properties would be against your collateral,
Mm,
against your investment. But it's important to note that every dollar invested is collateralized by a first lien in real estate. So if we disappear tomorrow, and this is very common, there's nothing unique about this. This is a very common product. In fact, I'll bet other people have spoken about this as an alternative investment to either you or your investors. There are several things we do distinctly that is different. For example, we corporately guarantee all of our investments. So if there's never a
mm.
loss that's incurred by one of our investors, we absorb that loss and immediately within 30 days replace the collateral. Now, you could think we're doing that because we want to keep our investor happy. That's the primary motivation. But the other reason is that there is risk associated with some sort of problem loan, and we would rather resolve that risk without involving the investor. And oftentimes, to be very candid, that's a revenue opportunity for our company. And so we take that asset, substitute it, and then move forward. Um, what we have found is most successful investors know that boring is better, like you said, and that something not sexy very predictable, that pays monthly, that has a very simplified reporting, is usually the best performing investment. As an example, if you think about the investments that you have yourself, think about the investments where you get just a 1099 versus a K1. You probably get a 1099 for a CD that you have, or an interest-bearing account that you have, maybe some treasuries that you have. Anything that you're getting a 1099 versus a K1 is signaling to you that this is a very simple, very not complicated investment. And in our passive income fund, our investors are paid a 1099. They're not paid a K1 because they're simply
Mm.
providing debt for the investment. They're not in an equity position where there's an outsized opportunity for risk and return. There's the risk profile for this investment is extremely low,
Mm.
because it's paid monthly, it's collateralized, it's insured, it's corporately guaranteed. There's a lot of belt and suspenders, if you will, that are in place for this type of investment.
What is the average interest rate on these fund products that we're talking about today? Um, and what is your kind of management fee structure on that?
Great question. From a fee standpoint, we all are familiar with the golden rule. Do unto others as you would have do unto yourself, and that's a great rule. But we try to live by the platinum rule at Zeus, which is do unto others as they would want done unto them. And for us, we have
Mm.
learned that investors don't like management fees, and they don't like the small, nuanced nickel and dime fees. And just like at your current your current banking relationships, where you have an account that has a certain amount of dollar amount invested, they don't charge you a monthly service charge, and they don't nickel and dime you for a wire or things like that. We don't. Our fee profile is very simple. Can I share what it is?
Please.
Zero fees. We don't charge when we have when our investor invests, they get a published interest rate, and that published interest rate is now a floor for them. So every 90 days, their rate can improve if the market improves. So if Wall Street Journal
Mm.
Prime goes up, every 90 days, our investors' yield will actually go up, and we adjust it automatically every 90 days. But from the moment they invest, that's their official floor. They cannot go below that. That's also why investing in any product that's debt, actually, not speaking about Zeus companies right now, but any product that's debt related right now, your audience would be very wise to look at debt investments. If they presume interest rates are going to decline, being investing in debt in an improving debt market or interest rate environment is actually better.
Mm.
There's more safety to your investment, and there's more margin to your investment. However, like, as I was saying, if once you invest at your published rate, it can only move up, it can never move down, and that's your net and your gross. There's no adjustment. We don't charge there's no catch-up provision for any. There's like typical funds. There's no asset management fee. There's no servicing fee. There's no collection fee. There's no wire fee. There's no ACH fee. When a borrower invests $100,000 and their published rate is 10%, they would receive $10,000. That's what they get, and they'll get that in monthly distributions.
So then, you know, too good to be true, right? So how do you make money?
No, not okay, great. It's not too good to be true. We make money because our borrower is paying a certain margin, and we assess the risk of that margin, and we only pay the investor at a lower rate. And so that arbitrage or that spread, what sometimes you refer
Yep.
to in our business yield spread, that's how we make money. We make the few points that are between what the borrower is paying us and what we're paying to our investor. That's why we absorb all the fees in that margin. Great question. That is our revenue model, as you said. And we've done this for $7 billion in transactions, 17,000 times. So it
Yeah.
works.
No, I assumed. I just want to make sure for folks who don't know those types of things that we
No,
explain
it's a
that.
great question. Thank you.
Yeah, of course. You've taken a fairly focused, I would say a very focused geographic strategy of focusing on Texas metro areas. Talk to me about why that's the decision that you've made, and why that's beneficial or good for investors.
The easiest answer of why we have chosen a very strategic focus is the first three rules of real estate, which we all know are location, location, location. And we know this location of Texas as a geographic footprint better than we know any other market. So we don't want to make a credit decision in a market that we don't know. And we really know the major markets of Texas. If you look at from an economic standpoint, Texas is one of the largest economies on the planet. If
Mm,
you look at population growth, we are the fastest growing. We have the four fastest growing cities in the country. In fact, three of the top five are in Texas. Four of the fast growing cities in the country are in Texas. Um, from an economic standpoint, when you look at the port of Houston, we're the largest port in the country. We do more importing and exporting than all the other ports in the country combined. So when you're
mm,
talking about consumer goods, when you're talking about relocation, the U-Haul index, if you're familiar, which is the index of tracking where U-Hauls are going in one direction, so people are relocating. Houston is still and has been for probably a decade the U-Haul index winner. Most people are
mm,
relocating to Texas for a reason because the business standard, there's no state income tax. The legal environment is very pro business owner and very pro landlord. If you invest, for example, as a landlord in New York, you can be waiting 3 to 5 years for a foreclosure. In
mm,
Texas, you're waiting about 30 days. So we have a very favorable business environment. We have low taxes. We have very large population growth, and real estate and jobs are directly correlated, not kind of correlated, directly correlated. Where you have any market that has had declining job growth, as an indicator, you will know immediately that real estate prices are depressed. If you have a market where you have rising job growth, you will have an improving real estate market. Well, Texas has had a rising market for a very long time, population market for
mm,
population growth for a very long time. And when you look at industry diversification, you're not just you're talking about oil and gas in Midland, Odessa. You're talking about the Med Center in Houston and in Dallas. You're talking about agriculture from the farmland. You're talking about manufacturing because of the port and how available the port of Houston is. 70% of all the goods that enter the port of Houston stay in Texas. That's how,
mm.
and we're the largest port in the country. So we're basically, it's a self-fulfilling prophecy. Consumers in the country buy things, they end up getting shipped into the port of Houston. 70% of them stay in Texas. And that feeds the market to then be purchased in our state because the population grows. That's a long way of saying there's not a better location in the country. If you look at the 5 to 10 most important indicators of a healthy real estate market, Texas has consistently been the winner if you're looking strictly from a
Mm.
real estate investing standpoint. So our investors value having some sense of geographic diversity because we don't only invest in Houston or only in Galveston or only in Austin and only in Dallas. We geographically diversify the investments, which is valuable to our investors. So there is geographic diversification, but we also add asset type diversification. We don't just lend to single family
Mm.
homes. We also lend on land, small balance construction, and basically the types of loans that we feel are safe and short term that provide a good yield and a predictable yield to our investor.
One of the ways I think to tease success, I mean, you could talk about the interest and all the payments that have been made back, so on and so forth. But one of the things that I find interesting is of the 7 billion that you've transacted into these deals, what was the principal amount that was initially like that you raise on initially bringing in a new customer right of that 7 billion, and how much of it just continuously is being rolled over and growing in size because you're paying them, interest and dividends and all of these things along the way.
Yeah, that's a great question. Let me answer that with just a simple example. We have multiple investors, multiple that are either retirees. We have a doctor who is in his late 40s, he's an ER physician. He no longer works as an ER physician. His entire income is generated from our fund, and he's replaced at his yield. He's making as much off of his principal every year that he was as a physician, and it's continuously growing. There's a story of a father who had a son going to college who called here to buy a rental property. He wanted to buy a fix and flip house,
Hmm.
and he was going to take his $150,000 and he was going to buy this rental property to cover the 1,000, $1,500 that his son was going to need in college for living expenses. And instead of after some evaluating some of his options, instead of him buying the property and being a landlord and dealing with the issues of being a landlord as an active investor, which he didn't have time for, he still had children at home and he still had a career. He decided instead to invest 150,000 making his $1,100 per month that he was given to us. So we funded his son directly out of the investment. And the fun part of this is when his son graduated with his degree, the $150,000 in principal was still sitting there waiting for the father to invest in
Mm,
something else. So it's the father, this investor of ours didn't do any active activity other than his initial investment. And every month for 4 years, his son was paid an allowance that the father wanted to. And at the end of the 4 years, the principal's still sitting there perfectly guaranteed, perfectly secured to invest in something else. And he didn't have to lift a hammer, go paint on the
mm,
weekend, go fix a toilet, and so forth. And even if you hire a property manager, the unknown expenses that are associated with real estate are real. And the only people who don't know they're real are people who actually haven't done it yet or haven't done the actual math, one or the other. And so this is a real niche for people who actually do have resources and don't want to be an active real estate investor. They want to be a true passive investor. And so you're making money like with CD simplicity. It's the same concept of the CD. You put your money in. There's a level of security. You can redeem the CD early for a penalty, just like us. You put your money with us in our fund. We ask you for a 2-year commitment, locked up. So we want to be able to make this investment work for you for 2 years. But if you change your mind, you can take your money out, and we charge a very small administrative fee to do that. And after
mm,
that time, every 90 days, you can take out 25%, up to 25% of your investment with absolutely no issue. So this is a very easy try it before you buy it kind of commitment. And you're
mm.
collateralized, you're insured, you're professionally managed. I already mentioned that our underwriting skill is our most unique skill that we have, and our best skill that we have. And we have a proven track record of over 20 years of doing this and doing it with a high degree of efficacy. I'm answering your questions long-winded and only because I want to give you as much information as possible. I'm sorry.
No, I appreciate it. No, it's super helpful. And actually, so you mentioned 2 years. Is that the length to get your full return, or does it take longer than that?
You're getting a return every month. So you're
In terms of getting all of your principal and interest that went into the fund, is that over a 2-year period, or is it longer than that, or is it
you're
evergreen?
it's evergreen. It's as long as you
Understood.
would like. And we have investors who have invested for over 15 years in the product.
Got you.
90
So after 2 years, you can pull out whenever you feel like it
And you can pull out even in the first 2 years. We just charge a small administrative
with a
penalty
little
because we've
penalty.
done a lot of setup to do that.
Sure.
Um, um, we keep in mind 94% of the people who've ever invested in this product still invest today. That's why it's
Hmm.
growing. That's why we're growing, and we have been growing. It's just quietly in the background, being the bank while other people are focused on, being an active real estate investor. We've been quietly focused on working with sophisticated investors who see the value in boring investments. And we like we're two philosophical statements I want to make. Number one, we are in the get rich slowly business
Hmm.
because we have found that people in the get rich quick business fail miserably. So we are in the get wealthy or get rich slow business, and one transaction at a time, one loan at a time, but safely at a time. And the second statement I'd like to make that you'll understand our philosophy is that we really believe in the Abraham Lincoln quote where he said, "We may walk slowly, but we never walk back." And for us, we're constantly improving what we're doing. Our investors are constantly reaping the benefits of that. And that's why we've had this really quiet in the background growth that we've had over the last 25
Hmm.
years.
Well, I want to get to, we have a whole bunch of questions that are coming in here, so I definitely want to start getting to them. But before I do that, you mentioned the get rich slowly. In that mindset, I think oftentimes that can make a lot of sense for a retirement account. Um, are IRAs allowed in your space? Do you have a specific IRA folks have to work with? Can they fund from their own IRA? How does that work?
We highly value IRA participation in this investment product. We Over 70% of the people who do invest with us do invest through some sort of qualified plan like an IRA, 401k Roth. That's self-directed. It doesn't have to be our self-direct. We don't have a self-directed product ourselves. We have affiliates that we refer people to, but and then when I say affiliate, not any, there's no remuneration. They're just people we've seen that do this well. But the accounts come from all over. from
Mm,
Fidelity to Inspire to anyone you can imagine. And this product is ideal for someone who wants to invest through a qualified plan because, again, you're getting a 1099 at the end of the year, not waiting for a K1 that's going to come in 8 months later or 8 months late where you don't
sure.
understand it and you have questions. You're getting a 1099 by the end of January, early February that shows you exactly what you made. Now, the downside to that is you're getting a 1099. And so if you can put that in a retirement account of some sort, the benefit to you is that you're either tax deferred or tax free, depending on the type of plan that you have. So yes, we highly encourage and even train. We've done trainings before for our investors on how to invest through
Mm,
qualified plans.
that's awesome. All right, let's start getting to some of these questions that have been coming in. First question. Are you able to underwrite or originate a loan secured by a property purchased via sheriff's deed in Texas during the 180-day redemption period? We currently
We
hold a portfolio of 23 properties with no existing debt and are evaluating value add strategies that include light rehab or repositioning on select acquisitions.
That's a great question. And the reason why that is a question is that the challenge with that type of loan, so they're asking as a borrower, not as a from an investor standpoint. And I appreciate the question. My main intention today was definitely to talk about what our investment portfolio looks like from a investing in notes, not from a borrower standpoint, but I love the question. And just to speak about that product, we don't lend on anything that's not a secured first lien with title insurance. So we won't make a loan where A, we're not in the first lien, and B, we require title insurance. And getting title insurance for that product is difficult, or that property is difficult that they described because you do have the redemption period. And so for any time during that period of time, the asset can be redeemed by the original lien holder. So for that reason, it's not a product that we would lend on. So we don't
Mm,
necessarily have solutions for that. We want to do things that are very simple and boring and need no imagination. And just by the very nature of that question, you could tell that's not simple and that's not boring. It's complicated, and I'm sure it's a great money maker with a great yield. It is a great yield. It's a published yield, actually. They're making 16 to 21% on those when they are redeemed. That's just not the business that we're in.
yep, it makes a lot of sense. Um, I think you pretty much already hit on this, but I just want to make sure we fully cover it. What type of tax form should investors expect to receive for monthly distributions? And is there anything at the end in terms of equity, or is it all structured as debt?
It's all structured as debt. There's monthly distributions and monthly reporting to that distribution. And our online portal is available 24/7, 365 anywhere in the world. Just like if you were logging into your bank account to look at a CD and look at your holdings, same process. And at the end of the year, your bank sends you a 1099 for they paid you, and your principal sitting in that CD. That's the exact same thing we do. We send you a
Mm.
1099 for what we paid you at the end of for the year. We send that to you in late January, early February, and your principal's still sitting in the CD, collateralized and corporately guaranteed.
Are the investment returns fixed or variable?
They're variable with a floor. Once you invest with us, you have a floor that you're going to earn, and that can range from anywhere from right now about 8.5 all the way to about 10.5%. That's how much you would make per year. That's the floor. It can only go up. If the market moves up every 90 days, we would move your margin up, and you would improve your returns.
Understood. Can you speak to transaction volume per year? How many loans on average are you making per year or month?
Yeah, we don't look at it like in that way. I'm not on the loan origination side of our business. I'm the founder of this company and I'm the founder of ZeusLending.com, but that's not the part of the business I keep myself involved in. I don't know the stats on the actual lending company itself. I will say it's important to note that ZeusLending.com is a licensed mortgage lender, mortgage bank, and mortgage broker. And what that means is we're audited
Hmm.
by the CFPB and the Texas Department of Savings and Mortgage Lending every 12 to 24 months. So we have been audited. We have a compliance audit every 12 to 24 months by the federal government and the state government. And what that does for our investors is it gives them just another level of, well, you could say peace of mind, but it's not just peace of mind. The federal and state government are looking at our loan portfolio and looking at our loan compliance every 12 to 24 months and in essence, certifying for us that we're 100% compliant. So just from a loan quality standpoint, we take a very high degree of pride in our loan quality and our loan structuring, which enables us on the investment side to make sure that we're offering very, very safe, predictable yields to our investors.
I feel like you hit on this one a bit too, but I again just want to make sure we're getting everything covered for these folks. It made sense that the interest rate will be my return. However, what is the ROI range on interest rates? Is it bespoke depending on the underlying asset, or is there a rate of return on a fund?
Great. There's no rate of return on the fund because you're providing debt. So you're not an equity participant in the fund. You through electronic certificates is how you hold your collateral. You get a certificate that shows your collateral that is pledged against your investment, and that collateral is your collateral. So if we die, disappear, go to Tahiti, retire, you still have first lien collateral that is securing your investment above and beyond our corporate guarantee. And in addition to that collateral, the ROI, your ROI, if you invest $100,000 and your floor rate or your introductory rate that's published is 10%, your rate will stay at 10% for the entire term. If rates go down, as long as they don't increase, your rate will stay at 10%. So if the market moves to 6 or 5 or 4, you'll stay at 10. If the market goes to 12, your rate and your yield will go up. So your ROI, or what we would say is your annual interest rate on your investment, is whatever your initial published rate is, as long as you don't invest any more money. If you invest more money, you're at a new tier, because every time you invest additional capital, you're eligible for a new tier. So the more comfortable you become with us, like any other investment, the more comfortable you become with us, the more we improve what you are actually making. And those rates are published. It's not bespoke, as the question was, and it's not based on the underlying asset either. What we pay an investor is strictly dictated on the amount that they have invested and how much they've invested in the past. That's it. There's no other indicator. It's not the underlying collateral. It's not their name. It's not their credit score. It is literally simply how much are they investing and when are they investing. At the market rate that they're investing at, that's what they'll get.
What is the historical default rate, and how much have you been able to collect on those defaults?
Um, Great question. The default rate historically is just over 1%. It used to be below 1% and has definitely trickled up since COVID, to be
Hmm.
north of 1%. When you're thinking about and from a collection standpoint, I would say, if you're familiar with venture capital investing success, I'm sure you are based on this program. You're familiar with the third, a third, a third. A third you hope that'll hit a home run or grand slam. A third will be modest, and a third will be mediocre. I would say it's probably 60, 20, 20. 60% of the assets we have, we make a decent return. 20% we may break even, and 20% we miss something, or the borrower did something nefarious that we didn't know about. When you take that as a blend of our entire portfolio, to be very candid, it's a revenue maker for our business. That's why we quickly and smoothly substitute the collateral and keep that asset on a separate set of books for us, because we're going to
Hmm.
turn the asset and make money on it. And it provides a guarantee to our investor who doesn't want the uncertainty of that. They just want to know we're going to handle it, and we handle it. But from a business standpoint, it's a revenue opportunity for us.
Yep, it makes a lot of sense. Is the opportunity to invest in a fund and or in individual loans, and what are the minimum investment amounts in each investment type?
There's no direct investment into a particular loan. The only way to invest with us is through the passive income fund. And again, that'll be open for capital on August 4th. And if you want information about that, you can actually go to zeuspassiveincome.com. That's the link if you want us to give you information about this fund, the passive income fund. If you go to zeuspassiveincome.com, Zeus passiveincome.com, that's where you'll go to get information. There's no way to invest in single notes. Regrettably, we can't do that for investors because it's a significant amount of work to work with an investor on a particular note. We want them in the fund, and most investors want to be in the fund because this is not a blind pool. You're not just giving your money you're going to have certificates for the exact collateral that is being assigned to your investment. And that provides an immense amount of value. So it is like you're investing directly in these notes, but you're doing it in a fund structure, but you're still providing debt. And what was the second part of your question that you asked? I apologize.
The minimum investment amount.
So our published minimum is 50,000. Our published minimum is 100,000. We make exceptions all the time to that for people who, for whatever reason, need to invest less. It's not whatever you're comfortable with. Anyone who's going to invest less than $100,000, we require what's called an investment strategy session, an ISS. That's where we walk the investor through the pros and cons and ups and downs, everything that we've said today, but in a detailed way, so they fully understand the investment. Because we have concerns when someone's looking to invest less than $100,000 about their sophistication and their alignment with a product like this, because this is not the kind of product. This is boring. You're not going to get more than the published rate. You get the money every month, but your return isn't going to end up in the triple digits. You're not going to be able to retire off of, if you were not going to be able to retire off this investment to start with, you're not going to be able to retire off of it when we're done. It's just a very boring but very reliable investment. Again, it's the CD of investing in real estate. That's the equivalent that we like to say. So you've invested in CDs. This is a little bit higher yield than a CD, more than double or triple of this mark of today, collateralized by real estate, corporately guaranteed, insured, first liens. Our average LTV is 63% across the entire portfolio. So you're talking about you have 37% that is a buffer, 37% because our average LTV is 63% in our loan
Hmm.
portfolio. So yes, that was a long answer, but the minimum
No, I
is
appreciate it.
the minimum is 100,000, but we make exceptions to the minimum once we do an investment strategy session to understand that this is a good fit for our investor. And we recommend that investors start at a lower amount. We don't want an investor dropping $250 million in our portfolio, $5 million, a million. We plenty of family offices invest with us. We ask them all to start at a smaller amount so they understand how we do it. It's very simple. And so sometimes that simplicity uh, gets overlooked because people are hoping there's something more. There isn't anything more. It's that
Hmm.
simple.
If people want to
You
sign
invest
up for
money,
the
you invest money, we pay you monthly, your principal's protected, we sending you a 1099, you take back your principal when you want it. It's really that simple.
if people want to sign up for that investment strategy session, do they just go to the website and there's a place to sign up for it?
They do. ZeusPassiveIncome.com.
Terrific. Are you monitoring the Port of Corpus Christi growth 11 records quarter in a row?
Corpus Christi is not a key market for us. We focus on the four major metros. I we don't focus on Corpus Christi. I'm not saying have not made loans there. I'm sure we have made loans in Corpus Christi. It's just not a market that we focus on.
Got it. I hold an IRA in Fidelity. If I were to invest 100,000 in Zeus with A, new money, or B, funds that are currently inside my IRA, what is the actual mechanism?
The mechanism is the same, whether it's in your retirement account or outside of your retirement account. The mechanism, if I'm understanding the question, is you would sign up on our portal once you complete the subscription agreement and get all your due diligence completed. Once you make that investment, let's just say, for example, it's through your Fidelity account, you would put the Fidelity account information in every month when we were doing your distributions, you would tell us the Fidelity account where you want your distributions going. And then when you want to cash out of your investment and get your principal returned, that money would also go either to Fidelity or wherever you tell us it should go. We don't manage the investment decisions of our investors. Our investors tell us where they want the money to go, including distributions. So we have investors that invest from one account, but want the distributions going to a different account. The father,
Hmm.
for example, I gave you earlier, he had his distributions going to his son's bank account every month, so his son could use that as an allowance while he was in college. So we don't control the allocation of money. An investor is free to put in their portal where they want the distributions going, and when they redeem their principal and they want it going, it can go to anyone they tell us. We don't
Hmm.
manage that on behalf of our investors.
Understood. I
Meaning,
just con
I said we don't manage it. I'm sorry, Chris. I said we don't manage it. We let the investor tell us where they want the money to
where they
go.
want
It's
it to
their
go.
money.
Makes total sense. Just confirming, you did already answer this. Do you get a 1099 or a K1? It's a 1099, correct?
Correct.
Excellent. I'm a resident in France. Can I make investments into Zeus?
You can. We have multiple out-of-country investors: Canada, Jamaica, China, Israel, Africa as a continent. Sorry, I'm not naming the country, but we have lots of non-residents who make investments in our portfolio.
Got it. I noticed on your website a Zeus Healthcare Fund. Can you share about the ROI in this fund?
Yeah, so that's not a fund. There's not a healthcare fund. We typically on the equity side, Zeus Equity Group has about $1 billion in assets that we own, commercial assets at
Wow.
Zeus Equity Group.com. And those assets are across the what we'd call the vanilla asset classes, not just multifamily, not just retail. We invest in all we're agnostic to asset class. Why are we agnostic to asset class? Because I said earlier, our unique skill is underwriting. So when you're a lender,
Mm,
you have to underwrite all sorts of types of assets. So when we are looking at an investment, I mentioned earlier, it's a multi-layered underwriting strategy. So we underwrite an asset that we're going to invest in. First, will it make money as an investment? And second, would we make a loan on this investment? If we wouldn't make a loan on this investment, we are not going to participate in it as an investor in any way. So our entire portfolio at Zeus Equity Group is made up of assets that have cleared our underwriting as a lender, though we didn't provide our own debt. We do underwrite like we are going to do that. And then on the healthcare side, that investment group is made up of much smaller group of investors who have the opportunity to invest in the healthcare companies that are often our tenants. So
mm,
primarily emergency medicine. We exited our position in 2023, so 2 years ago, but we started and ran the second largest private network of emergency rooms in the city of Houston. We're building a specialty hospital right now just outside of Galveston with the most profitable hospital operator in the United States. And we own part of the equity in the actual operation of the hospital, not just the real estate portion. And so it's not a fund; it's single asset investments. We don't have a fund for either one of those, Zeus Equity Group or Zeus Healthcare. The equity group, we haven't exited an asset at lower in over 20 years. We have never exited an asset with below a 16% IRR. And we have $1 billion portfolio. We've never exited an asset with less than 16% IRR. Now, we've had some really good IRRs, but they were on accident because we don't shoot for investment. We don't go for investments that are going to have very high IRRs because those are almost always associated with risk. So we have an investment, for example, we made a few years ago in Dallas, and we made 43% IRR for 5 years. It was an accident. We didn't know we were going to make that return. Our return was actually published was at 19%, and we just happened to have some things go our way that we weren't expecting. On the healthcare side, the IRRs are much higher because they're operating companies, and it's based
mm-hmm.
on the operating company investment. And we've had no losses in that investment portfolio at all, and we started it in 2010. So
Wow.
we've never made an
Uh,
operating company investment, and we've never lost money. Um,
Unbelievable. Can I reinvest within the fund without receiving distributions?
you can. We that is possible. We have found that a lot of investors prefer to have that money routed somewhere else because you're from a collateral standpoint, it becomes very difficult to collateral. If you're getting a $900 monthly distribution, our investors see the value in having collateral against their investment, first liens in real estate, and it's difficult to give you collateral for $900.
Hmm.
So that money is for a period of time wouldn't be collateralized because it's difficult to give you collateral for that amount of money. So yes, we have investors who do that, but we would encourage you if that's your most important factor that you have collateral, we would encourage you to have that money sent somewhere else and then send it back. Or we would walk you through the fact that until this dollar amount gets to $25,000, it's very difficult to give you collateral.
Do you have skin in the game, i.e., have you invested your own money?
Yeah, I have $12 million invested in the portfolio of my own cash. 12
I think
million if
that's
you're watching.
pretty convincing. Um, cool. Please repeat that IRR from the Zeus Equity Group.
We have never exited an asset. We have assets right now that we're still holding. That's why I keep saying we have $1 billion in assets that that we're holding that we've invested over the last 5 to 10 years. But we've never exited an asset. We've had many exits, several. We can show you a report that shows them. We've never exited an asset with less than 16% IRR net to our LP investors.
Terrific. think we have hit on all the questions that have come through. If any others are out there, definitely drop them ASAP. In the meantime, if people are interested, they want to invest, whether it's 100K or maybe they're looking to invest less to get started, where should they go? What should they do?
If you are interested in investing in this really boring but really predictable investment, what we call the CD investing of real estate investing, you would go to ZeusPassiveIncome.com. That's where you would go. August 4th is when the fund will be open for new capital. We have 94% of the people who have ever invested in this product still invest. So our need for capital is a very fine balance of satisfying our loyalty to investors who have been with us the entire time, and then trying to create opportunity for new investors and not change our loan quality. We have a very stringent and very strict underwriting matrix that we stick to. And yes, we're always monitoring that for loan quality, like the question was earlier about volume and things of that sort. But we don't want to ever be under the pressure to deploy capital in loans that we don't have. And so we're always monitoring this very careful ebb and flow. We can take new capital because we have new loans, or we don't want to ever be in a situation that we're taking capital and we have to force loans in there. And so that's why August 4th is the go live date. A couple key points that I would love to mention
Please.
about the passive income fund. Number one, it's guaranteed monthly income. There's a zero default risk to our investor because whenever there's a loan that's in default from a borrower, we simply seamlessly replace it with a new loan, and then we manage the default through our other servicing company. These assets are professionally managed through our servicing department. It has a Texas real estate focus, so you get a really strong focused market knowledge that we've acquired over 25 years. It's a very transparent structure. You invest, you get a 1099 at the end of the year for what you invested, and you can withdraw your principal for the first 2 years with a small administrative fee like a CD, or 25% every quarter from that point forward, forever, evergreen, like you said. There's quarterly rate stability, meaning once you invest with us, your rate cannot go down. It can only go up. So you'll only earn more money. You'll never earn less than your published rate. And you can bump that rate up by investing more later. So if you started a low amount and you thought, okay, I'm going to invest more, you'll end up in another tier, which will help you have a higher yield. And we have a proven model. Like I've said, we've done 17,000 transactions and over $7 billion in real estate. So this is not something we're new to. We've been doing this a very long time.
Well, Dr. Kaufman, thank you so much for your time and thoughtful insights today. Look, I think this is a really, this is not financial advice, but I think it's a really interesting way of diversifying into the real estate sector, and getting kind of those, lower risk investments with really nice returns. And if you keep rolling that over, it does become worth a lot of money over the long term. If you look at 10% compounding interest over 20, 30 years, if you're thinking about retirement, that could actually be quite exceptional, especially if you continue to add to it over time as well. So, I think it's pretty amazing. Track records count for a lot. The fact that you've been at this for 20 years and have done thousands and thousands and thousands of transactions, it's really impressive. So this is definitely one, in all the years that I've been doing this, I'd put this in kind of that, from just my own personal opinion, in that top 5-10% of kind of all of the, like, doing it the right way, for the right reasons and performing really well. So congrats to you on all of your success. And for those interested, definitely go check out Zeus Companies and let us know, if this event was helpful for you, if it helped you make an investment decision. We're here to educate and to help and kind of be the boring alt investor supporters or providers, right? We want to help you think about these things in a logical, rational way, not always the most exciting way. And so I think we're very aligned on that front. So thank you again for your time today. Thank you to all of you for attending and for your wonderful questions. And we hope you have a wonderful day. Take care, Nick.